Hello and welcome to Kemet Capital, the community of holders and seekers of African capital. I'm your host, JS, and as always, we're going to start with our word of affirmation. The guiding principle of this community is the Cobb and Douglas production function. On our way to make Africa great again, as you already know, guys, it's through economic might and strength. We need to produce more in a more efficient way. The topic of today's article is total factor productivity, which is the change in output, not from input. Let's jump into the article. Bet on Nigerian recovery draws investors seeking to dodge trade wars, Africa's most populous country among former crisis hit economies attracting foreign inflows. Exchange between two Africans, dollar for naira. Interesting picture, great illustration. So, as always, we start by the order of the article. It's Anu Adeoye. We already know Anu, the West Africa correspondent for the Financial Times, and is based in Lagos. Covers politics, business, technology, and economics. And also Joseph Porterreal, who is an emerging markets correspondent for the Financial Times. Foreign investors have flocked to Nigeria's markets in recent months as the threat of a US trade war with larger developing economies has sent portfolio managers looking for cover in former crisis hit frontier markets now on the rebound. That's good to know that we were a crisis frontier market. The Nigerian naira is among the world's top performing currencies since November's US election, with a rise of more than 7% against the dollar, as a turnaround in the continent's most populous nation and the lure of yields of 20% to 25% trigger a rally in the local bond market following massive devaluation. So this is the yield chart for the 10-year Nigerian bond from 2017 to today. So this is all it comes from. The source of the data is from World Government Bonds. So this is the historical. This is the 1 year. We can definitely see the peak here at 22% in January 2025. Just look here. Oh no, again, we're gonna hit the resistance here at 22%, and here as well. That looks like 18.5 or something. So still pretty significant yields here. So these variations actually they reflect the dynamic nature of Nigerian's economic landscape. Instead of being stagnated, it's actually a dynamic. It includes factors such as inflation rates, monetary policy decisions, and global economic conditions. So this is, I want to say, um, the market that it's alive, right? You can see up and down, peaks and valleys. So I was able to identify the cause of the recent decline in yields of the Nigerian government bonds. And those elements are identified here down low. So those are the cause of this, rally into the Nigerian um, sovereign bond, basically. So in first, you have economic reforms. Huge, huge, right? Economic reforms because, not because, but the administration of President Bola Tinubu has implemented significant economic reforms, including the removal of fuel subsidies and the devaluation of the naira. These measures have stabilized the currency and enhanced the appeal or attractiveness of local assets investors. The second element was the central bank policies. The Central Bank of Nigeria has adjusted its monetary policies, notably reducing the benchmark interest rate by 50 basis points to 13.5% in March 2025, the first cut in 4 years. This move aimed to stimulate economic growth and has contributed to the decline of bond yield. So here, if we go back here on the chart, around March, we dropped the policy rate. The Central Bank of Nigeria, let me just go back here so we know what we're talking about. We're here talking about the central bank, which has taken steps to improve dollar liquidity, including lifting restrictions on foreign investors participating in fixed income auctions and considering the issuance of US diaspora bond. So they're enlarging their pool of investors, allowing foreigners to come and be able to uh, to quote or bet on those participate, in the auction. So these actions, all in all, they have bolstered investor confidence and contributed to the naira's appreciation, basically. The third element is the improved dollar liquidity. What is the improved dollar liquidity? So the Nigerian central bank interventions such as selling dollars to foreign exchange bureaus and settling 7 billion backlog in forward commitments. So they had debt of 7 billion in terms of currency that they need to pay to economic participants. That has enhanced dollar liquidity in the market, and it has also narrowed the supply demand gap and supported the naira's appreciation. So one something that we can emphasize on the 7 billion that we talked about earlier is a backlog. So the 7 billion is a backlog, right, in foreign exchange, and the commitments refer to accumulated unmet obligations by the Nigerian central bank to provide foreign currency to various sectors, including banks, aviation, and manufacturing. This backlog resulted in from foreign exchange shortages, leading to delays in fulfilling these commitments. So basically, you're a company, you do business, all your money or your US dollars are held by the central bank. At some point, you need that money to reinvest or to purchase more machinery, but the central bank is holding the cash because they want to hold on the reserves. So what they did when we talk about improved dollar liquidity, so they actually paid back those investors with the money that was held at the central bank coffers. So among those 7 billions, there were invalid claims. So apparently, not apparently, it is reported that the forensic audit by Deloitte Consulting revealed that about 2.4 billion of these claims were invalid due to issues such as lack of proper documentation and non-existent entities. We know how we do in Africa, guys. Always looking for a little piece to win here and there. So you have 2.4 billion in invalid claims. So the valid claims were 4.5 billion and were considered legitimate. You know, and what happened is that the clearance of these of valid foreign backlogs has contributed to the appreciation of the naira, as it has restored confidence among market participants and reinforced Nigeria's commitment of honoring financial obligation promptly and effectively, basically. So, final element of this appreciation in the naira is to increase foreign investment. And actually, this is the middle because to me, at least, it's a consequence of all the three previously stated cause. So for increased foreign investment, we have global trade tensions. Foreign investors have been seeking opportunities in frontier markets like Nigeria. The Nigerian naira has appreciated over 7% against the dollar, as we've already mentioned, bolstered by attractive bond yields of up to 25%. This influx of foreign capital has driven bond prices up and consequently yields down. So all these combined effects, all those four have led to an increased demand for Nigerian government bonds, as we've said previously. So increased demand, drop in yields, elevating the prices and resulting in lower yield. Let's kind of put a bow on this nice package. Okay, let's go back to the article here. The rally in Nigerian assets reflects how idiosyncratic trades or specific bets on countries coming out of currency crisis or defaults are in favor as investors are finding it increasingly hard to read how US President Donald Trump's threat of tariffs will affect emerging markets as a whole. Interesting. Donald Trump causing people sleepless night. He's trying to he's trying to bring a new world order where Now everybody is kind of protectionist, isolationist. Everybody is looking for itself instead of the liberal, uh, neoliberal market that was promoted by Western societies or civilization, I want to call them. Even though everyone is doing a rethink with Trump's policy, yes, exactly, because he's basically, as I said, is changing the new world order. Before it was globalization that was in favor. Now Trump is like, nah, man, go back to nationalization. And the inflation impact, if at all, of tariffs, investors are looking for potential places to invest. That might be able to be resilient to all of that to all of that going on in the background, said Razia Khan, Standard Chartered's head of research for Africa and the Middle East. Commodity exporting frontier economies such as Nigeria are less integrated into the US economy than richer emerging markets that produce higher value goods such as automobiles and or electrical goods. So basically, we're not competing so much with American industries since we are only basically merely providing commodities. We're not providing finished products or high-end electrical goods. That insulates the former group from wider tariff-driven sell-offs, said Alexei Domones, debt portfolio manager at Ashmore, the emerging markets asset manager. They don't have high trade surpluses with the US, and that's exactly what Donald Trump is against. He wants to be, he basically, quote unquote, he wants a level playing field. You want to sell in the US, produce in the US. Since we're not producing anything, we are not a threat to them. They are not, is it good? Is it bad? Only the future will tell us. They are not as exposed to the noise from tariffs in general, he said. Many of these countries are also coming off very difficult periods after high global interest rates in recent years led foreign investors to pull their money out, which exposed weak currencies and sent governments either to the IMF for help, begging, or forced drastic self-help economic policy. So this is austerity, cutting spending, increases taxation. Egypt, Turkey, and other countries that were hit by capital flight have enticed investors back in the past year with tough economic medicine to raise interest rates, dropping to raise interest rate. Dropping unsustainable pegs to the dollar has helped drive double-digit returns on local currency bonds. Nigerian local currency government bonds have also performed well, especially in the past month. So we're gonna stop here, guys, because I took this opportunity, or at least this article gave me the opportunity to discuss about current foreign exchange currency regimes. Right? What is it? What is a currency regime? So an exchange rate regime refers to how the country manages its currency relative to others. So these regimes range from fixed, peg, to floating, with hybrids in between. So we're going to discuss each main type here highlighted on the picture here. So at first you have the fixed rate regime. So you have the hard peg, the hard peg. You have countries such as Panama, Ecuador, all the French African colonies. For the hard peg, the currency is completely fixed to another with no fluctuation. This is supposed to provide stability, but it also limits monetary policy and the flexibility. So you have there after the hard peg, you have the soft peg. The soft peg, the currency is fixed, but it can be adjusted in response to economic conditions. The central bank intervenes occasionally to maintain stability. So you have hard and soft for the fixed. Now, if we move on to the floats, we have the free float. So, sorry, for the soft peg, we have countries like Saudi Arabia and China as an example of countries using soft peg currency regimes. Now, moving into the floating exchange rate regimes. Here, the currency value is determined by supply and demand in the forex market, so it's free float with minimal or no intervention to central banks. So among the float, you have the free float, as we're saying, exchange rate fluctuate based on market forces, trade, investment, speculation. The central bank does not intervene at all. Only a few African countries let their currency float freely based on market demand and supply with minimal intervention. You have, for example, for example, on the free float in Africa, the South African Rand. So South African Rand is free float currency. The Zambia Kwacha, I'm not sure if I pronounce it well, Kwacha, Zambia Kwacha, also free float, and also the Uganda shilling is a free float. Now on the managed float side, the currency is mostly market driven, but the central bank intervenes occasionally to stabilize volatility. It's very popular in many developing economies, and it's most common in Africa because it allows for some currency flexibility while reducing excessive volatility. The government still has some control over the exchange rate without committing to a strict peg. This is here the managed float. And you have Nigeria, who started this regime in 2000, as of 2004 after removing forex restriction. You have the India rupee, who is managed but not strictly pegged, and you have the Russian ruble. The third category, not type of currency regime is a hybrid, like anything, like dolphins. You have a hybrid, a mix of fixed and floating elements with some central bank intervention. So at first you have the crawling peg. The exchange rate is adjusted gradually over time instead of being fully fixed. It helps avoid sudden devaluations. You have countries like Ethiopia and Argentina historically has used a crawling peg. You have a currency band. Here, the exchange rate is allowed to fluctuate within a fixed range. The central bank intervenes if it moves outside of this range. The example of countries: Denmark, which is pegged to the euro within a band of two plus or minus 2.25%, and you have Botswana, who is pegged to a basket of currencies. I don't know which one. Maybe you guys can tell me in the comment. And the final hybrid is the dual exchange rate system, where a country operates two exchange rates, one for official transactions and another for the open market or black market, i.e., black market. So it's used in cases of forex shortage. You know, they try to put a cute name in it, but it's just a black market. So some countries that use that regime were Nigeria before 2023 and Venezuela historically. So those are the regimes. I thought it would be interesting to discuss that with you guys, and here it is. Now let's go back to the article. Many emerging market hedge funds produced their best returns in years by chasing these opportunities last year, and similar moves in dollar bonds of countries such as Argentina and Ecuador. Foreign portfolio investors are thinking Nigeria could be the next Turkey, said Charlie Robertson, head of macro strategy at FIM Partners. There's been proper change in the fundamentals of the Nigerian economy. We discussed some of those economic reforms that the Nigerian government has introduced and put in place. 2 years ago, you had a currency that was uninvestable. Wow. Wow. That's some big word. Nigeria's stock market has gained about 4% in recent dollar terms this year. 4% in dollar terms this year, better than many bigger markets. Nigeria had fallen off the radar for many international investors in recent years as controls on the naira made it difficult to extricate profits. We discussed about when we talked about the improved dollar liquidity, we discussed about the 7 billion backlog in foreign exchange. This is exactly what the article is referring to here by making it difficult to extricate. So now that The dollar is back in our pocket, we can move on and it becomes more attractive. Since President Bola Tinubu took office nearly 2 years ago, his government has removed fuel subsidies that had burned up foreign reserves, while the central bank removed a peg that propped up the value of the naira and increased rates to 27.5%. Currency lost 70% of its value against the dollar after two devaluations, but it has stabilized since November and is currently trading at what many observers believe is closer to its fair value at 1,541 to the dollar. That's still very high, guys, but it's already a win if it's stabilized by the market with minimal intervention, as we've shown in the currency regime that they are on right now as a managed float, right? Is a currency mostly market driven, but the central bank intervenes occasionally to stabilize the volatility. There's been a series of economic reforms that have really made a difference in the tradability of Nigeria from a local currency assets point of view. The Mones said. Under the previous administration, the naira was kept at an artificially high level. So investors don't like that when there's too many government intervention. We like when the market is free. Free market is the most efficient market. He said if you had invested in a prior period and you had to get dollars out, you had to get in the queue. Again, we're talking about the 7 billion backlog in foreign exchange that we identified earlier. Despite this, the inflows of dollars from bonds bought by foreign investors and the recovery in oil production to a 4-year high last month, Nigeria gross reserves have fallen so far this year to 38.5 billion from 40 billion. Investors said the drop was likely to reflect central bank paying down debt, the backlog again, that inflated the gross reserves measure. This will improve net reserves, but these are not published. Policymakers also appear to be targeting stability or slight appreciation in the naira, investors added. I think they are intervening to make sure the naira doesn't come under speculative attack. Said Bismarck everyone. Why is your name Bismarck? You're not German? You never go to Germany and see a German call, I don't know, Tunji or Olomide or Olowanji. Come on, man. Bismarck? Nah, man. I don't like seeing that. Chief Executive of Lagos-based consultant financial derivatives. My personal worry is that if oil prices drop, or there is a real reversal in gains from foreign portfolio inflows, the currency could be at risk. Oh, that's a good point. That's a very good point. So if foreign investment stops, so the capital flow, the value of the currency will also be affected. But this is the risk that you take when you move to a floating exchange rate regime. You know, you take risks. Those are the risks that you're supposed to take. Da-da-da. Inflation is also elevated at 23% as of February, with higher food prices driving the high cost of living. For the second leg of the trade, you need to see this inflation kick in, said Demones. 10 charts can said we shouldn't underplay the very real pain that ordinary Nigerians have felt through this liberalization experience. The pain that people took may mean it takes a while longer before the benefits of all this are realized. While the naira still appears cheap and insulated from trade risks versus other emerging markets, it has become a more populated trade for foreign investors. One manager said, the more interest there is in these trades, the less idiosyncratic it is in terms of risk. Exactly, the more popular you are, the less diversification you provide, because everybody is flocking into the asset into the market. All right, this is the end of the article. Interesting one as always. You guys let me know what you think in the comment, and I'll see you in the next one. Bye.